Welcome to Griffonomics.
Glad to be here for this one. It's a fascinating topic.
Yeah, imagine a company building over 20,000 homes a year, generating billions in revenue, but absolutely refusing to own the dirt those homes sit on.
It sounds totally counterintuitive for a builder.
Right. But today, we're heading into a stack of SEC Form 10-K filings, financial disclosures, and strategic analyses surrounding NVR, Inc., which is one of America's largest home builders.
And a highly unusual one, structurally speaking.
Exactly. Usually when you look at the balance sheet of a major home builder, you expect to see billions of dollars tied up in raw land. It's a notoriously heavy, capital-intensive industry.
Oh, absolutely. Heavy machinery, heavy debt.
Yeah. But NVR operates more like a high-efficiency capital allocator that just happens to manufacture houses.
That's a great way to put it.
So today's mission for you listening is to unpack NVR's legendary asset-light inflection, analyze the very real cracks forming in its 2025 financials, and see how its valuation holds up as giant competitors actively try to beat NVR at its own game. Okay, let's unpack this.
To really grasp the competitive advantage here, we have to look at the traditional home building cycle, right? And why NVR abandoned it decades ago.
Right, because the old way is pretty risky.
Yeah, historically, a builder buys thousands of acres of raw land, spends years and, millions of dollars, securing zoning, laying down infrastructure, and then eventually building homes.
Which requires taking on massive debt.
Exactly, massive debt. And when the housing market inevitably cycles downward, the value of that raw land just plummets.
Which triggers those catastrophic balance sheet write-downs we always see during a crash.
You got it. NVR recognized that holding land is essentially just real estate speculation. They decided they didn't want to be speculators. They wanted to be manufacturers.
And the mechanism they use to pull this off is the lot purchase agreement, or LPA.
Right.
Instead of buying the dirt outright, NVR controls roughly 95% of its land. By the end of 2025, the filings show that was 169,250 lots.
That is a staggering amount of land to control without actually owning it.
Yeah. They go to a third-party land developer and put down a non-refundable cash deposit, typically up to 10% of the aggregate purchase price.
Mm-hmm.
And that deposit buys them the right, but not the obligation, to purchase those finished lots at a predetermined price later on. So it's basically like paying a non-refundable fee to hold a reservation at a fancy restaurant rather than buying the whole restaurant just to guarantee a table.
That's a perfect analogy. And doing that fundamentally rewrites the risk profile of the entire company. But you have to think about how this actually works on a granular level.
Right, like who's actually taking on the risk then?
Exactly. How does a local developer finance the purchase and development of raw land if NVR is only putting down 10%? The secret is NVR's balance sheet.
Oh, interesting.
Yeah, the local developer takes that signed LPA from NVR to a regional bank. NVR's sterling credit rating and just their sheer size essentially act as the collateral for the developer's construction loan.
Ah, I see.
So NVR leverages its corporate stability to make third parties take on the actual debt and ownership risk. If the housing market crashes, NVR can just walk away.
They just forfeit the 10% deposit.
Exactly. They lose the deposit, but their maximum loss is strictly capped. They don't have billions in depreciating land dragging them into insolvency.
So it's essentially an options contract on real estate.
Yeah.
You pay a premium up front for the flexibility to execute the trade only if the market conditions remain favorable.
And the financial consequence of paying that premium is what drives their astronomical 34.7% return on equity.
Wow, 34.7% is huge.
It's industry leading. Because NVR carries minimal land, their equity base is practically non-existent compared to a traditional builder.
Right.
When you push billions in revenue through a highly optimized manufacturing process on a tiny equity base, your percentage return on that equity just skyrockets, even in a tough macroeconomic year like 2025.
That 34.7% ROE looks incredible on paper, but when you look at how the broader market actually prices that capital efficiency, the math seems to kind of break down.
It really does.
Yeah, like if you look at NVR's price-to-BIC ratio, they're trading at about 4.9x. That is more than double the industry median of 2.2x.
Right.
For a lot of value investors, seeing a PB of 4.9x in the home building sector flashes a massive red warning light that the stock is wildly overvalued.
What's fascinating here is that the price-to-book metric is fundamentally broken when applied to a company like NVR.
How so?
Well, book value is intrinsically tied to the hard assets a company owns. But because NVR's entire corporate strategy is designed around not owning assets, their book value is artificially hollowed out.
Oh, okay.
Yeah, so when you divide their stock price by an artificially depressed book value, the resulting ratio inflates to 4.9x. It's really just a mathematical quirk of the asset-light model.
That makes total sense.
Investors who actually understand the space ignore the PB ratio entirely. They value NVR on its cash flow generation, which gives them a historical 10-year average PE of 15.8x. Right now, they're trading at about 16.8x, which is a clear premium to their peers.
Which brings up an obvious strategic paradox. If the market is willing to pay a 16.8x multiple for this capital efficiency, and, the blueprint is sitting right there in NVR's SEC filings, why hasn't the rest of the industry simply copied the homework?
Oh, but they are actively trying to.
Yeah.
Industry analysts are calling this the race to asset light.
Really?
Oh, yeah. The mega-cap builders have realized they're being penalized by the market for holding heavy land assets, and they are restructuring aggressively. D.R. Horton is a prime example.
The biggest builder in the country.
Right. They've pushed their lot control up to 75%, which is about 444,900 lots without direct ownership.
But D.R. Horton didn't just go out and build a grassroots network of local developers like NVR did over decades, right?
No, they took a very different path.
Yeah, they engineered a captive supplier. They took a 62% majority ownership stake in Four Star Group. So Four Star goes out, takes on the debt, buys the raw land, and develops it. And because D.R. Horton controls them, they get first dibs on the inventory.
It's pretty clever.
Yeah, the filings show last year, 83% of the lots Four Star sold went straight to D.R. Horton.
It gives D.R. Horton the balance sheet protection of an asset-light model, combined with the vertical integration of an asset-heavy model. It's a hybrid-light approach.
Right.
But Lennar has taken an even more radical approach. They are trying to execute a pure-play pivot to match NVR's 95% threshold.
What, Lennar?
Yeah, by late 2025, Lennar reported controlling an unbelievable 98% of its total home sites, nearly 500,000 lots through option contracts.
Wait, if Lennar is now at 98% asset-light control compared to NVR's 95%, didn't Lennar just out NVR? Does the pioneers still have an edge when the giants copy the homework?
Well, you have to look at how they did it. You execute a massive piece of financial engineering. Lennar orchestrated the Millrose spinoff.
Right, I saw that in the notes.
Yeah, they took $5.6 billion in land assets sitting on their balance sheet, packaged them together, and spun them off into an entirely independent land bank called Millrose Properties. And then Lennar immediately signed a master agreement with Millrose to buy that exact same land back on a just-in-time construction schedule.
It feels like a massive accounting loophole. They just shifted the dirt to a different entity to make their own balance sheet look cleaner to Wall Street.
It does feel like that, yeah.
So does NVR actually still have an advantage there?
This is the ultimate test of NVR's model. On paper, Lennar's percentage of controlled lots is now higher, but spinning off an asset base is not the same as replicating NVR's operational DNA.
That's a good point.
NVR spent 3 decades building granular, street-level relationships with hundreds of independent developers. Their entire corporate culture, incentive structure, and supply chain are built around the constraint of not owning land.
So they know how to actually operate in that environment.
Exactly. Lennar essentially cloned the menu, but they haven't proven they can run the kitchen. Once that Millrose inventory inevitably runs out, Lennar will have to compete with NVR in the open market to negotiate those third-party lot purchases.
Here's where it gets really interesting. If Lennar and D.R. Horton successfully match NVR's financial structure, NVR's remaining moat isn't just how they finance land, it is where they build.
The geography.
Yeah, the geographic data in these filings is staggering. The Mid-Atlantic region, so we're talking Maryland, Virginia, West Virginia, Delaware, and Washington, D.C., is the absolute economic engine of NVR.
It is unparalleled concentration for a national builder.
Yeah.
That single region generates roughly $4.4 billion in annual revenue, which is nearly 200% of their next largest segment. They command a massive 20% market share in the Washington, D.C. metro area alone.
And the mechanics of why D.C. acts as a moat are rooted in bureaucracy, right?
Yeah.
It is notoriously difficult to build there.
Oh, absolutely. Red tape everywhere.
You are dealing with incredibly strict zoning laws, historic preservation boards, and prohibitive raw land costs. If you're a national competitor trying to break into D.C., you simply cannot find cheap land, and you don't have the 30 years of local regulatory relationships required to get a new subdivision approved. NVR practically owns the toll bridge.
They do. But a toll bridge only generates revenue if traffic is flowing.
Right.
That immense geographic concentration is simultaneously their deepest moat and their most glaring vulnerability. Because they are so heavily anchored in the DC metro area, their revenue stream is disproportionately sensitive to federal spending cycles.
So D.C. is their fortress, but isn't that putting all their eggs in a very bureaucratic basket? If federal spending freezes, doesn't NVR catch a massive cold?
Yes, exactly. A shift in administrative policies, a government shutdown, or a federal hiring freeze impacts a massive portion of NVR's target demographic all at once.
Which brings up a fair dose of analytical skepticism. If they are so insulated by this asset-light model and this geographic fortress, how do we explain the massive warning sign flashing in their southeast segment?
2025 numbers.
Yeah, in the third quarter of 2025, NVR's profits in the southeast collapsed by 40% year over year. A 40% drop in a single quarter breaks the narrative of this being a bulletproof model. If they don't own the land, how do they bleed so much margin?
Well, they bled margin because the LPA model can actually trap you when local inventory spikes.
Oh, really?
Yeah. During the pandemic boom, NVR aggressively locked in LPAs in fast-growing Sunbelt markets. But when demand cooled and local inventory surged in 2025, NVR was caught out.
Because they had already committed.
Exactly. Competitors who owned their land outright could simply mothball their projects, halt development, and weigh out the cycle. NVR doesn't have that luxury.
The clock is ticking on those contracts.
Right. Under an LPA, they either had to follow through, build on those lots, and sell the homes at heavily discounted prices to move inventory, which crushes margins, or they had to completely walk away and forfeit their 10% deposits.
And looking at the 2025 financial realities, the macro climate forced their hand in a brutal way. We saw mortgage rates hovering around 8%, creating extreme affordability headwinds. Buyers were hesitating, pushing the cancellation rate up to roughly 17%. As a result, NVR's net income fell 20% to $1.34 billion, and their backlog of homes shrank by 15% to 8,448 units.
The shrinking backlog is the critical metric there. That is their pipeline of homes under contract but not yet built. When the backlog shrinks, it means the manufacturing floor is slowing down.
Right.
But the most revealing number in these disclosures is the impairment charge. In 2025, NVR recorded $75.9 million in contract land deposit impairments.
You mentioned the LPA model protects them from buying bad land, but $75.9 million in abandoned deposits sounds like a pretty big leak in the lifeboat. At what point does asset light just become death by 1,000 lost deposits?
If we connect this to the bigger picture, you have to look at their liquidity to see why they can absorb that deductible without blinking.
Okay, let's look at the cash.
Despite a 20% drop in net income, NVR ended 2025 with $1.88 billion in homebuilding cash. They operate with a negligible 0.27 debt-to-equity ratio.
Wow, okay.
So losing $75 million in deposits stings, but it doesn't threaten their solvency in the slightest. In fact, that $1.88 billion cash pile is an offensive weapon. While land-heavy competitors are drowning in interest payments on depreciating dirt, NVR has the dry powder to step in and buy distressed, fully developed lots on the cheap from over-leveraged regional builders.
And they are aggressively deploying that cash, just not into raw land. NVR famously refuses to pay a dividend. Instead, they funnel almost all of their free cash flow into stock buybacks.
Yep.
In 2025 alone, they bought back $1.82 billion of their own stock, consuming 97% of their operating cash flow for the first 9 months of the year.
It's massive.
And then in February 2026, the board authorized another $750 million repurchase program. By constantly shrinking the denominator, the amount of outstanding shares, they artificially support their earnings per share, which keeps that premium valuation intact even when overall net income drops.
It is a phenomenal demonstration of capital allocation driven by extreme executive stability.
Leadership.
Yeah. The leadership team steering NVR isn't learning on the job. CEO Eugene Bredow is a 20-year veteran of the company who took the top spot in 2022. CFO Daniel Malzahn has been running the financials since 2013.
So they've seen this before.
Exactly. They have navigated these exact cyclical waters before.
And they are clearly thinking about the next evolution of the manufacturing process, too. They recently added George Oliver to their board. He's the former CEO of Johnson Controls, which brings serious global industrial-scale expertise to the table. They are treating home building less like real estate and more like an advanced assembly line.
That manufacturing mindset positions them uniquely for external market catalysts, too. The sources highlight a major political catalyst from early 2026, a privately funded initiative called Trump Homes, which is aimed at closing the national housing supply gap through private pathways to ownership.
And just to be explicitly clear to you listening, we are not endorsing the viewpoints or politics of this initiative, but simply reporting on the source material we are analyzing today. The sources note that while Lennar was directly cited as a collaborator in this initiative, the news actually triggered a sector-wide rally, bumping NVR stock up 3.7%.
Right, and the reason an asset-light manufacturer like NVR bumps on that news is purely mechanical. Any federal or private initiative aimed at rapidly closing the housing supply gap will likely involve bypassing traditional zoning delays or opening up federal land.
Okay, fine.
So, if you suddenly have a massive influx of available lots, the companies that can instantly scale their manufacturing output without having their capital tied up in legacy land banks are going to capture that market share the fastest.
So what does this all mean? If we step back and look at the whole picture, it feels like a sports team relying on their veteran coaches to weather a rebuilding season. The playbook is good, but the weather on the field is terrible right now. The LPA strategy and capital efficiency, it's undeniably brilliant, but 8% rates, margin compression, and aggressive mega-cap competitors cloning their financial structure, it's a tough environment.
That tension is exactly why the strategic outlook rates NVR as a hold or core long-term position. NVR is a world-class compounder, but currently it is a show-me story. The market is watching that shrinking backlog and the 40% profit drop in the Southeast. This raises an important question. Can NVR realistically maintain its premium 16.8x valuation multiple if the housing downturn extends deep into 2026 or 2027?
It's a big if.
Investors are currently paying a premium for the safety of the asset-light model. But if the manufacturing floor keeps slowing down, that premium will become incredibly difficult to justify.
Let's quickly recap the journey we've taken today. NVR built a legendary business by realizing that owning dirt is a liability, not an asset. They pioneered the lot purchase agreement to shield their balance sheet, generating industry-leading returns on a tiny equity base. But today, with Lennar executing $5.6 billion spinoffs to reach 98% lot control and D.R. Horton engineering captive suppliers, the competitive gap is closing fast.
Very fast.
Combine that with NVR's heavy reliance on the D.C. metro area and the reality of absorbing $75.9 million in abandoned deposit deductibles, and you can see why this specific model is facing its ultimate stress test.
Which leaves us with a fascinating paradox to consider. If the ultimate destination of the entire home building industry is to become 100% asset-light, if everyone spins off their land and just becomes a just-in-time manufacturer, does the competitive advantage of capital efficiency eventually drop to zero?
It's a great point.
Yeah. If nobody wants to hold the risk of owning the dirt, does the real economic power inevitably shift right back to the developers and the land banks who actually own the ground we build on?
Risk defined, portfolio protected.